Hi there. In reading 33 of the CFA curriculum, we'll talk about financial reporting quality, the red flags and accounting warning signs that the analyst should look out for. We'll start by gaining an understanding on low quality earnings, the fraud triangle, and wind up with a discussion on accounting warning signs that the analyst should look out for. So low quality earnings doesn't mean that the earnings are low or the profitability is subdued. Rather, low quality earnings are earnings that are not sustainable for reasons that the earnings have either been over-reported or under-reported, and we will just see the motivations and methods of achieving the same. So management may be motivated to overstate net income to meet earnings guidance that it may have communicated to shareholders and other analysts, comply with debt covenants, or possibly just to receive higher bonus and other incentives. So many other reasons also exist for the management to overstate net income. Managements may sometimes be motivated to underreport earnings in order to obtain relief from regulators and other agencies, saying that the business is already in a very poor shape, so regulation should be more favorable. Negotiate favorable terms from lenders. And similarly, low earnings may be used to negotiate favorable contracts with employees and labor unions. So many reasons exist for over-reporting or under-reporting earnings, which is why they may not be sustainable or the quality of earnings becomes low. Firms may also be motivated to manage the balance sheet, that is, over-report or under-report on the balance sheet. So overstating assets or understating liabilities would make the firm appear more solvent, that it has more assets and more equity, less liabilities. On the other hand, if the firm shows lower assets, that may result in higher return on assets and higher turnover ratios, which may sometimes be more desirable. So what are the different ways in which the management can manipulate the earnings or the balance sheet? So basically, the accounting principles can be exploited to achieve a specific outcome while meeting the letter of the accounting principles, but not the spirit. So please understand that low quality earnings are not fraud. So these earnings have been reported within acceptable guidelines but not in the right spirit. If there is an indication of fraud, then we say that the earnings have no quality and the statements should not be used at all. We'll study this in the coming slides. For example, selecting accounting principles that misrepresent the economics of a transaction, wherein the POCM method more fairly represents the construction of the contract, the management may choose to employ the completed contract method to delay profit and revenue recognition. Structuring transactions to achieve a desired outcome. So even though management has purchased an asset, they have entered into an agreement with the seller such that the purchase looks like an operating lease and no debt or assets come on the balance sheet. Using aggressive or unrealistic estimates and assumptions, so overstating the salvage value of assets, extending the depreciable life are some common examples. Managements can abuse the intent of an accounting principle as well. For example, unrealized gain or loss for a trading security is allowed to be taken on the income statement, as the assumption is that these securities will be sold in a short period of time and this unrealized gain will actually become realized. However, management can exploit the principle by classifying a large number of securities as trading securities when the value is likely to go up, even though the intent is not that of trading. So these were some examples of how earnings can be manipulated by abusing the accounting principles. Now, fraud is not just an abuse of the accounting principles. Fraud refers to cheating or illegal deception in literal terms. And if present, we will conclude that the earnings have no quality, and obviously they cannot be used for any economic decisions. So fraud is normally seen to happen in the prevalence of three conditions. That is the opportunities for fraud, incentives or pressure on the management, and an attitude or rationalization that the fraudulent behavior is justified. And note that all of these conditions need not be present for fraud to occur, but generally fraud happens when there is an incentive, opportunity, and wrong attitude. Incentive is the motive to commit fraud, opportunity is when there is a weakness in controls, and attitudes or rationalization represent a mindset that fraudulent behavior is justified. So many incentives or pressures can potentially exist on the management to commit fraud. For example, threats to financial stability or profitability as a result of economic conditions, industry, or competition. Excessive third party pressures could be from shareholders or unrealistic expectations of analysts, stock exchange requirements, debt covenants and repayment requirements, etc. And it's been seen that the pressure is more when the personal net worth of the management is directly threatened because of a significant financial interest in the firm, or if the compensation is based on achieving aggressive targets for the stock price or operating profits, if the management has given personal guarantees on the debt, etc. Excessive pressures to meet sales targets or other financial goals can also sometimes motivate people to commit fraud. Now, opportunities for the management to commit fraud are higher in industries or operations where there are significant related party transactions. The management has the ability to dictate terms and conditions to suppliers and customers. The accounting process requires significant estimates and judgments. The business has a lot of unusual or complicated transactions that are generally not seen. If the firm has a lot of international operations where cultures and business practices differ, and if the company is seen to have bank accounts or operations in tax havens without any clear business justification, then in such cases we see that the opportunities for fraud are potentially higher. Opportunities will be higher if the management is not being monitored effectively, that is, if the management is dominated by a single person or a small group, or if the board of directors or audit committee is not exercising sufficient oversight. We've seen that the opportunities for fraud are higher for unstable organizations where it is difficult to determine who is actually in control. The structure involves a lot of legal entities or unusual lines of authority, and we see there's high turnover amongst management, legal counsel, or board members. And last but not the least, opportunities will be higher if internal controls are not strong. That is, inadequate monitoring, high turnover amongst accounting and IT personnel, and ineffective accounting and information systems. So incentives and opportunities will translate into fraud if the attitude and mindset is incorrect. So attitudes and rationalizations to commit fraud are evidenced by inappropriate ethical standards or failure to effectively communicate or support a firm's ethical standards. Excessive participation by non-financial management in the selection of accounting standards and estimates. Unknown history or allegations of violations of laws and regulations by the management and board members. If the management seems to be obsessed with increasing the firm's stock price, management makes aggressive commitments to third parties for achieving results. There is a failure to correct known violations in a timely manner. The firm inappropriately minimizes earnings for tax purposes. You find that the management is repeatedly using materiality, that is, saying that the information or principle is relevant and must not be omitted as a basis to justify inappropriate accounting methods. And very importantly, if you find evidence of a strained relationship between the management and the auditor, so if there are frequent disputes on accounting, auditing, or reporting issues, unreasonable demands being made from the auditor, restricting the auditor's access to people and information, limiting his ability to communicate with the board and the audit committee, and if you find evidence of domineering management behavior towards the auditor. All this would indicate that the management has attitudes and rationalizations to commit fraudulent behavior. So what are the warning signs in the reported accounts that should make an analyst wary of earnings manipulation or fraud? First would be to see if aggressive revenue recognition takes place. For example, there are bill and hold arrangements whereby the company bills and recognizes revenue before the product has been shipped or delivered, so the firm is still holding it. If there are too many sales type leases where as a lessor the company is recognizing a lot of upfront profit, if you see that significant revenue is coming from swaps and barter transactions with third parties, then all these would be indicative of aggressive revenue recognition and possibly low quality earnings. Now, operating cash flows and reported earnings on the income statement can differ for a year or two because of accrual accounting. However, over a longer term, the sum of the operating cash flow must match with the sum of the earnings over a 2 to 3 year period. So if operating cash on the net income is consistently less than 1, that is, the operating cash is lesser than the net income, then it's a sign that the management is potentially overstating net income, or there can be some write-offs in the future. If the company is reporting abnormally high sales growth as compared to its industry and peers, then again the analyst should be wary and recheck the accounts. Abnormal inventory growth as compared to sales growth may indicate that the firm is understating the cost of goods sold. So the analyst must recheck before he projects the gross margins out in the future. If you feel that non-operating income or non-recurring gains, for example, sale of plant and machinery or sale of scrap, which is not going to be a recurring feature, is being clubbed as a part of recurring revenues, then again it is suggestive of low quality earnings and earnings manipulation. Just like aggressive revenue recognition, firms can also boost profits by delaying expense recognition on the income statement. Abnormal use of operating leases may be a sign of balance sheet manipulation, whereby assets and debt would be understated and the return on assets debt equity ratio would look better than they actually are. Firms can also try to hide expenses by classifying them as extraordinary or non-recurring so that the EBIT margin and the operating profit looks good. We'll study LIFO liquidation with a numerical example at level 2. But understand that in an inflationary environment, if the firm is following the last in first out method for inventory valuation, and the firm makes the following purchases and sales over the next 3 years. So 10 units are bought in 2010 and 8 are sold. In 2011, 12 units are purchased and 9 are sold. In 2012, 14 units are purchased and only 11 are sold. So at the end of 2012, I would have an ending inventory of 8 units, 3 from 2012, 3 from 2011 and 2 from 2010. Since we are following the last in first out, the earlier purchases that were at lower costs, since it's an inflationary environment, these 2 units that were purchased first would still be sitting at inventory. These 3 units purchased first out of these 12 would be sitting in the inventory, and likewise the 3 units here. So when in 2008 the firm sells 8 units, and because it is anticipating a slowdown or for whatever reason it doesn't make any further purchases, so it just wants to liquidate its inventory, the revenue for these 8 units would come at 2013 prices, whereas the cost of goods sold for these 8 units would be this ending inventory, which is at a lower cost since it was purchased at the beginning and we are in an inflationary environment. So you see that in 2013 the company's profit margin and profitability would look very good. But please note that these profits are high not because sustainably the company's gross profit margin has improved. It's just because low cost inventory procured earlier is flowing through the income statement in this period, and hence the profits look good. So these earnings are not sustainable. This is the concept of LIFO liquidation we'll understand in more detail at level 2. Abnormally high gross margins and operating margins also warrant more investigation. If you see that the firm is extending the useful lives of long-term assets, then again it will boost profitability in the short run because of lower depreciation expense, but there'll be a one-time loss when the asset is retired at lower than its book value since we didn't properly depreciate it. So the ending book value will be higher than the salvage value. If the firm is using aggressive pension assumptions on mortality, discount rate, etc. to reduce the pension expense, then again the actual cash outflow in the future may be higher than what the firm has accounted for. Any year-end surprises in profits warrant a deeper investigation to see if these surprises are sustainable or if the earnings have been manipulated. If you see that the firm is using the equity method of investments and not consolidating its subsidiaries, then again this may be a sign of balance sheet manipulation, as assets and liabilities will be understated, boosting the turnover ratios and the debt equity ratios as compared to full consolidation. So we'll study the equity method and consolidation at level 2, so don't worry too much about the specifics of this manipulation. And finally, any other off-balance sheet arrangements. For example, the company has given a guarantee that if any other firm defaults, then this company would provide financing for the debt servicing of the other company. All such arrangements are accounting warning signs and should be analyzed more rigorously. So that was about the review on reporting quality and accounting warning signs. Not a very numerical topic again, so make sure you go through the video once again just to remember and revise all the concepts. And it should normally not be too tough to attempt a question from this section. Thanks a lot and see you next time.